Let's talk about the pros and the cons of using leverage in real estate investing. Guys, leverage is what makes the world go round, and it's important to realize how this works. One of the great things about a piece of real estate is I can go get a 30-year fixed loan, which basically means that interest rate will not change for the whole 30 years that I have this loan. As long as I pay it on time, that interest rate is not going to change. It also means my payment is not going to change for principal and interest. Now, taxes or insurance could change, and that could go up or go down, and that would make an impact on my taxes and insurance, but my principal and interest is going to stay the same for the whole 30 years. But here's the great thing. The reason why that's amazing is when we come look at what happens to property values over time, if you come look at the median house price in the United States, you can see a trend. And the trend is it just goes up. Now, are there ups? Are there some downs? Yes, you can see these downs are kind of highlighted here if the down is for too long. But you can see there's very few downs when we're looking at this since, I don't know, 1980. We would consider 1, 2, 3, 4, 5. But you could also see since 1980, the price went from 61,000 all the way up to 403,000. So a significant increase in value. That's the cool thing about this leverage concept is I can tie down this payment and make it fixed, but I can tie down the asset, which let's just look at this and say you just paid off the house and it's 2025 and it's worth $403,000. So 30 years earlier, so 1995, you bought the house for $133,000. Okay, so this house is worth 3 times, 300% more than what you actually paid for that house. That's amazing. The other thing is rents go up over time. Let's get our rents chart. Okay, so let's just say rents are $1,200. And we'll come back here to 1995. Rents were $523. So if you were able to make your payment based upon what the rent was and just break even along the way, by now you're cash flowing significantly, $600 a month is what you're cash flowing, and you're sitting on an asset that's worth 300% more than what it was when you actually acquired the property. Now, here's the even cooler thing. If interest rates go down sometime over that 30-year period, you can refinance. Let's say rates end up going to 4%. Well, you can refinance and get the 4% rate so you can take advantage of that and lock that in for another 30 years. Now, I will tell you, when you're using leverage, my recommendation is you always get a 30-year fixed. I would not recommend doing any type of variable rate because you want to make sure you can cover that payment with the way the situation is right now, not hoping in the future things will become better. So the question then becomes, let's say I have $100,000. Should I put all that $100,000 towards one house, or should I put $25,000 into 4 houses? So my question is how much do you believe that rents are going to go up over time? My other question is how much do you believe that property values are going to go up over the next 30 years? And if you believe that from a financial standpoint, you would be so much better off getting 4 houses at $25,000 down payment. You'd get financing and everything else like that because each one of these houses is going to go up 300%. Every single one of them is going to go up. And the rent on every single one of them is going to go up. However, I am managing 4 properties instead of managing 1 property. So I'm using the leverage to do that. The pro side is I'm using leverage, which means rents and those things as they go up in the next 30 years, I'm going to see the benefit of that. The downside to that is I am managing 4 properties rather than just managing 1 property. Now, I will tell you from my perspective, especially if we're looking at like these rental properties, if you manage properties correctly, they are not a serious hassle. Everything that's hassles that you hear about toilets and tenants and problems and all that stuff really comes down to a poor management system. If you have a management system that is in place and you follow it and you hire the right tenant. That's one of the things that we learned early on. We'd rent to anybody that would pay as much money as possible. We quickly learned we actually didn't want people that would pay as much as possible. We actually wanted people that wanted a good deal, because good people want a good deal, just like we wanted a good deal. And so we would rent to properties that were we would put our rents at $50 to $100 less than market. Now you say, well, why in the world would you do that? Because if I'm always $50 to $100 less than market, I'm going to be that way for the whole duration. And I'm going to find somebody that wants to be less than market, and they're going to want to stay there for a very long time, as long as the house that I'm renting works for what their needs are, which is one of the reasons why I like 4 bedrooms, 2 bathrooms, 2-car garage typically. It doesn't have to be, but 4 beds, 2 baths is typically what I'm looking for on that, because then I'm getting somebody that's going to become part of the community, stay there a long time, those types of things, and then renting below market and hiring the right tenant. So if you're going to hire the right tenant, if you are going to properly manage the properties, putting a little bit on multiple properties so that you can see the appreciation factor and you can see the rents go up over time is going to give you a lot more long-term wealth growth and cash flow than just doing one. I also think something's very interesting to see here. If you look in 2007 at the peak, this would be the worst real estate crisis of all time. 249, we'll just call it 250, okay? 250,000. What did that price go down to at its low? Let's just go down here, 205. Okay, do you want to know what's interesting about this? Do you want to see the difference between these? $45,000. Guess what? That's 20%, it might be 21%, but let's just call it 20%. So you can see the worst decline we have ever seen is 20%. So if you could buy these houses for $100,000, you put $25,000 down, even if values went to the lowest we've seen in the history of real estate, you still would be not underwater if you add 20% down on each one of these properties, as long as history repeats itself and we don't see more than a 20% decline. And that's interesting because a lot of the banks want you to put 20% down. Why? Because that's the magic number to ensure that they don't get upside down on one of these properties. So this is when it comes down to leverage, why you should be looking at multiple houses, why leverage can help, and why leverage can hurt, because it is a double-edged sword, and making sure that you're being responsible with the leverage so that you can grow your real estate empire.